Hello there, what have we got this week then? We've got another bad performance from my portfolio. I'm down 0.52% and all three life strategies are up by a touch. So what's went wrong for me? Let's have a look. Here's just the usual numbers. I've automated it, as you can see. I now just enter the date there. Nothing major. I suppose that's quite major, isn't it? 3% down. And I checked, it didn't go ex-dividend during the week, so it's not like I've got that excuse. I mean, I think that could just have been a bit of a pullback from the previous week. I think, was it last week or the week before when it went up quite a lot because of that China news, that China stimulus? And then when it comes to all of my personal stock picks, there's very much a, what's the word I'm looking, bifurcated? Is that the right word? My pharmaceuticals and my banks are doing quite well, but then my property and my renewable energy ones have done quite badly, so they kind of even each other out really. But yeah, not great, but it's not a disaster either. There's all the information in one go. And then in the Fundsmith portfolio, which gets way more attention than the rest just because it's more fun. I think if I remember correctly, there was just a big move in Crowdstrike, which is making some steady progress over the past few weeks. It's gone from like a 2% position to a 2.33% one. And then Fortinet, which is its stablemate in the cybersecurity business. I think they do slightly different things, but I'm not exactly too clear. But yeah, that one's been a good performer generally, really. That's gone from, when I first bought it, it was quite a, no, it was not far off where it was now, but it did badly for a little while, and then it had quite a bit of a recovery. That's what's making me think. But actually, yeah, I was going to say it's done well, but it hasn't. It's had a bad time and then a good time, so it's kind of equaled out. But actually, it is a higher proportion than it started off right at the beginning, so it's done well overall, but not quite as great as I almost said then. And Novo Nordisk seems to have just had a comeback from the previous week where it did really badly. I think it was down about 5%. But anyway, there's the Fundsmith portfolio. And the dividends, bit of a dry spell. I mean, numbers wise, I've had small weeks like that before since I've been doing this, but it's just the quantity of them, the SCHD, all the tiny amounts from SCHD. I'm thinking maybe they mostly come at the end of months rather than at the beginning of months. And there's only two there this week. But yeah, there's the numbers, 48 quid. Now in terms of the income, I just pieced together, what I've done here is I've just done a little projection. So last week I went through the yearly results and how my dividends increased over the year. So I thought I'd have a little look to see how we're doing in general for the year ahead. Here's my projected income of 12,735, but I've tempered it a bit, 35 quid less. And as we can see here, I've calculated that we're already at a projected 3.66% increase compared to last year when we compare those two numbers. So hopefully we're already in a good position here to do well compared to this year's inflation. When I say dividend projection for the year, I don't really mean that literally. What I really mean is it's like a base level. It's a worst case scenario. Because, for instance, what I have projected there for City of London is 5.25p in each quarter. But as we can see here, in May each year, we get a dividend increase. I haven't accounted for any dividend increases in City of London. So it's kind of a worst case scenario. So two of the payments will be higher than I've projected here for City of London. For Henderson International, for instance, I've got projected 1.92p for each quarter. But actually, all four of those are going to be higher probably. And same for Scottish American. Scottish American has a kind of increases year to year rather than quarter to quarter. So each one of the four will be higher. So when I say it's really good, but the numbers is kind of a reasonable number, isn't it? What I mean is that's the base level. It's going to go higher than that as we progress. This number of 12,700 includes my tempering of expectations in terms of these. Yeah, I think it's those four where I've got factored in some reductions, 30% reduction, 30% reduction, 50% reduction, 50% reduction, no, sorry, 47% reduction. If we actually, if for the full year I didn't sell any of those ones and I just kept them invested how they are and the dividends came through as expected, my actual projection for this year is 13,139. 13,139. So the portfolio as it stands is already 7.25% higher dividends than last year, which is crazy high. But I mean, a lot of that, if it is just me picking ridiculously high yielders, like Gore Street Energy, yielding 12.75%, Next Energy 10.94%. They're unrealistic ones. That's why my projection has it there like that, and that's why in here I'm not going to fool myself and think that I've already banked a 7% increase in my dividend. That is not how I'm looking at it. We'll go to the transaction I made this month. Well, actually, sorry, this week, a couple of days ago. In Fundsmith, I used to have Visa, and I also had Mastercard. And I bought Mastercard because I was Fundsmith owned Visa. That's why I owned that, and it was in its top 10, so that's why it was a position. It was up here. But what I've actually done is I've switched Mastercard and Visa, so that Mastercard replaces Visa in the Fundsmith portfolio. You can see there, Jesus Mary and a Visa alternative to the one that was in Fundsmith. I mean, I get the impression that Terry Smith himself would be kind of ambivalent. If someone told him you have to sell Visa and you have to buy Mastercard, I don't think he'd be too upset about it. But that's what I've done, because it's not a big deal for me. It's a small position. He'd have to sell millions and millions of it, wouldn't he, to make that switch if he wanted to. The replacement is Moody's, and that's because that's what I've done. I've replaced Mastercard with Moody's, and I've replaced Visa with Mastercard, if that makes any sense at all. So basically what that boils down to is I sold all of my Visa in both accounts, the ISA account and the Invest account, there and there. And then I put 300 quid into Mastercard to make Mastercard the size of Visa roughly, or the size of what Visa used to be, approximately. And then the remainder I put into Moody's in both the accounts. So there's a small hold, there's 300 quid in the ISA account and a bit more than that in the Invest account. You may have noticed I had Moody's in this watch list for ages. It's another one of Joseph Carlson's holdings that I'm copying. I started to get a bit uncomfortable having too many of those card payment things. It just, part of it is because when I was travelling around Asia, well, I say Asia, all I went to was Thailand and Vietnam, but pretty much all of the locals, they just used an app on their phone, which was essentially, as far as I can tell, it was just using an app which just sends the money straight to the merchant's bank account, which is just like me sending a friend money if he pays for me dinner or something. And as far as I could tell, there was zero charges being put onto the merchant, zero charges being put onto the customer. And it just seems to me like these card payment people, they get money for not doing a lot, and I wonder if that's too cushy a business. I mean, I'm not that bothered about it, but I just think me going above and beyond what Fundsmith holds in that sector is probably a bit too risky, and I should just go to approximately what Fundsmith holds rather than having an extra 2.5%. And I prefer Mastercard. It just seems growthier. It's got a smaller market share, but it's gaining market share on Visa. And it's a bit growthier, a bit of a lower yield, but the Moody's yield that replaces it is pretty similar to Visa's yield. So it clawed back a bit of the income. But I mean, the income's irrelevant in the Fundsmith-ish portfolio anyway. I'm happy to let that yield go down. That move I've been pondering for a little while, but this often happens to me. I'll be pondering a move, but what triggers me actually doing it is just some random moment. And the random moment that triggered me doing it was I was watching the Compound YouTube channel, which is Josh Brown and his company do loads of YouTube videos. And he was interviewing somebody who is expert in this payments area of the market. And he said that he much preferred Mastercard to Visa. That kind of confirmed that I wanted to put Mastercard there, and sell Visa rather than keeping Visa and selling Mastercard. And yeah, Moody's is just pretty similar to SPGI, which is S&P Global. Although I don't think Moody's has any indexes like the stock market indexes like the S&P 500. S&P Global, they get paid money for all of those trackers that track that index. So Moody's doesn't have that business, but they do all of the credit rating stuff as that S&P Global does. And it seems to me that Americans love their credit. So it's kind of a similar market. It's like an adjacent market. It's related to people borrowing money, although, you know, Mastercard and Visa isn't just about borrowing money. I mean, they don't lend money at all. They just facilitate it. But they have credit cards that they get money from, but they also have debit cards, so it doesn't have to be about loaning money. Anyway, there we go. That's why I bought Moody's. But, you know, none of these things are my recommendations. I don't even fully understand why I'm buying these myself. This portfolio here is essentially me just copying people that I see online, and it's really just a bit of fun. As usual, never copy me. You saw the results of me in the last video, didn't you? Why anyone would ever think of copying what I do is beyond me. I'm surprised even a handful of you watch this, to be honest. I recorded that this morning and I'll splice it in now. So a post on Reddit instigated me looking at this little screen here that's shown on Trading 212. I've always seen it, but I never paid much attention because I use my own spreadsheets to track these things, and I don't really care what the FX impact is. I just kind of look at this number instead. But it got me confused about how they calculate the FX impact and the gain that's not based on the FX or not caused by the fluctuations in the exchange rates. And it got me confused because looking at the numbers, they didn't make sense. So I've copied my own little example here. It's Apple. So what I did was I've just tried to work out what they're doing to work out these numbers. So if we go through it, I've just put in my number of shares. I've copied across the average cost price from here in dollars and in pounds, and I've used those to work out the exchange rate from the time they were purchased. So I used that then to work out the cost in dollars. I used it to work out the cost in pounds. I copied across the share price from here. I then worked out the value in dollars, the current value in dollars that is, and I copied across the current value in pounds. So this is the exchange rate they were using at the time the app was calculating these numbers. And as you can see, what I've worked out is just by looking at these numbers, it seems pretty obvious to me that the app is using the percentage change in the currency conversion number, and they're using that as the FX impact. You could easily make the mistake of thinking that that's correct, but I don't think it is correct. If we look at this simplified example, what I've done is I've just created this simplified example of an investment that costs you £100. It then gains 50%. So I've put in 150, it's gained 50%. And it has then had 10% taken off it. Now that 10% taken off it is the equivalent of the exchange rate going down by 10%. But as we can see here, taking off 10% reduces the value to 135 from 150. So that reduces the profit from that to that, and it reduces the percentage profit from 50% up to 35% up. And we can see that that is 15% reduction in the profit percentage, but we've taken off 10%. So you can see there that the FX impact on the profit, which is what they're trying to show here, isn't 10%, it's 15% in this example. And that's because the 10% FX effect should get applied to the whole 150 quid. It doesn't just get applied to the 100 quid, which is what they're doing here effectively. What I've done is I've copied over the formulas where I've worked out what they're doing. I've just copied them across. So in this example, I've simplified it so that we start off with a one-to-one FX. And their calculations that I've simulated here, I've got my calculations to match here. with what they're doing, and then I've copied across the formula, and we can see that their formulas would have told us that the FX impact is 10%. But we know, just by looking at these simple numbers, that FX impact should be 15%, because that's how much it's reduced the profit percentage by. So yeah, it's just wrong. I don't understand what they're doing. They've only applied it to the cost, which is just wrong. So that, I mean, to me, this is what they should do. They should work out the profit, which is E8 minus E5. That's the profit in dollars. Value in dollars minus cost in dollars. And they should then multiply it by the exchange rate from the purchase dates. That is the gain stroke loss based on a world where there's no currency fluctuations. So that is the profit I would have had if there was no fluctuation in the currency, and that's what should be shown, because the FX impact is being stripped out of the profit that we show in that position on the thing. So it shouldn't be £50.12, it should be £51.74. So then we work out the FX impact is just the difference between the return in pounds that I've actually got and the return in pounds if there's no fluctuations in FX. So this is how it should be calculated. But obviously, at the moment that's a small difference. But if we had much bigger profits, we can see there that the bigger the profit, so now the profit's 140% rather than 20%. We can see obviously the bigger the numbers, the bigger the profit, the bigger the effect their, in my mind, erroneous calculation has on the results of the FX impact. To me, it's obvious that they're doing it wrong. But I'm sure they would never listen. So yeah, just a little warning to anyone who uses Trading 212 that the FX impact that gets calculated there is inaccurate. All they're doing is showing how the exchange rate has changed, and this number's meaningless because in reality, it's bigger, or it's smaller. If the FX, if there was a loss on your holding, the FX impact would be smaller because the FX change, this number would be applied to a smaller number then rather than a larger number. Anyway, there we go. That's my little rant at Trading 212, calculating things wrong. But anyway, yeah, like I say, it doesn't really matter to me because I just work out my own numbers, and the FX impact I don't follow really. I just let it happen. There we go. Me moaning about Trading 212. Anything else to say? I think that's it, to be honest. Why wouldn't I be honest? I hate that phrase. To be honest, I'm not quite sure. So you're admitting that you're not honest a lot of the time? Is that what you're saying? You're saying you're a liar, but today you'll do me the honour of telling me the truth. Is that what you're saying, really? Anyway, God's sake, what am I talking about? Okay, see you next time. Bye-bye.